Welcome back to the Deep Dive, everybody. Today, we're taking a journey through the history of finance. We'll be using Niall Ferguson's book, The Ascent of Money, as our main guide,
Ah, The Ascent of Money, a classic.
for sure. And I've also got some articles and my own notes here. Should be a good time. You ready to dive in?
Absolutely. I always find it fascinating how something as seemingly abstract as finance has played such a pivotal role in shaping the course of human history.
Right. And Ferguson does a great job of making it all come alive. He doesn't just focus on the dry, technical stuff. He brings in the stories of the people, the innovations, the rivalries, and the sometimes disastrous consequences that have driven the evolution of money and markets.
It's a very human story when you think about it.
Totally. And he starts off with a pretty stark example to illustrate just how much our world revolves around finance.
Okay, I'm intrigued. What's the example?
Well, he points out that back in 2007, the average American earned about $34,000 a year, give or take.
Got it. Typical middle-class income.
Right. But Lloyd Blankfein, the CEO of Goldman Sachs at the time, earned a cool $68.5 million. That's like 2,000 times more.
Wow, that's a pretty staggering disparity.
It is. And it really highlights the point that the financial system, while being essential for economic growth, doesn't always distribute its rewards fairly or equally.
It's a reminder that financial literacy is more important than ever, especially in a world where the returns on capital often outpace the returns on labor.
For sure, knowing how the system works is crucial if you want to navigate it successfully.
Absolutely. It's not just about getting rich, it's about understanding the forces that shape our world and making informed decisions.
And speaking of understanding the forces that shape our world, Ferguson also issues a warning about the cyclical nature of financial history.
Okay, I'm listening. What kind of warning?
He argues that financial crises aren't just random events, they're a recurring feature of the system itself.
That's a sobering thought. And he uses the 2007 subprime mortgage crisis as a prime example, right?
Exactly. It's a complex event, but in a nutshell, it was triggered by the bursting of a housing bubble that had been fueled by easy credit and some, let's say, questionable lending practices.
Right, subprime mortgages. Those were loans given to people with less than stellar credit histories.
Exactly. And the real kicker is just how interconnected the global financial system had become. Ferguson talks about how families in the U.S. struggling to pay their mortgages were linked to banks in Europe through these complex financial instruments called CDOs.
Ah, CDOs.
Yeah.
Collateralized debt obligations. I remember those being in the news a lot back then.
They were everywhere, but I have to admit, I never really understood what they were. Something about bundling mortgages together and selling them off to investors.
Yeah, you're on the right track. Essentially, they took a bunch of loans, including these risky subprime mortgages, bundled them together, and then sold them to investors as seemingly safe investments. Well, they were marketed as being relatively low risk because they were diversified. The idea was that even if some of the mortgages went bad, the others would still perform well enough to cushion the blow. But in reality, many of them contained a significant portion of those subprime mortgages.
So when the housing bubble burst and people started defaulting on those mortgages, these CDOs became like toxic assets.
Precisely.
Yeah.
Their value plummeted, causing massive losses for the banks and investors who held them. And because these CDOs were traded globally, the crisis spread like wildfire.
Yeah, Ferguson really emphasizes that this wasn't just an American problem. It was a global crisis because the financial system had become so tightly woven together.
It's amazing how seemingly isolated events can have ripple effects across the entire world. It's that whole butterfly effect thing.
It is. And Ferguson points out that this kind of interconnectedness isn't a new phenomenon. Throughout history, financial crises have often spread across borders, sometimes with devastating consequences.
We humans have a knack for repeating our mistakes, especially when it comes to finance.
It seems like it. But before we delve into all those historical crashes and booms, Ferguson takes us all the way back to the very beginning, the origins of money itself.
Ah, so we're going back to the basics. Bartering, maybe? Trading goats for wheat?
Well, he does mention bartering as a precursor to money, but he quickly moves on to the emergence of more sophisticated forms of exchange, like cowrie shells, beads, and eventually metal coins.
It's amazing how those early forms of money, like cowrie shells, held value simply because people agreed they did.
Right. It's all about trust and shared belief. He really emphasizes that money, at its core, is a social construct. It's not inherently valuable in and of itself. Its value derives from our collective willingness to accept it as a medium of exchange.
That's a really important point. I mean, think about paper money. It's just paper, right?
Mhm.
But it holds value because we all agree that it does.
Exactly. And that makes me think about all the debates surrounding cryptocurrencies these days.
Yeah, good point. It's like a modern-day example of how money is ultimately a matter of belief and social consensus.
People are either passionately for or against crypto, and a lot of it seems to come down to whether they believe it will become a widely accepted form of money in the future.
It's a fascinating case study in the evolution of money, playing out right before our eyes.
Agreed. So, from cowrie shells and crypto, Ferguson then takes us on a journey through the history of coinage, exploring how different societies have used metal coins to facilitate trade and accumulate wealth.
He probably talks about gold, right? The ultimate symbol of wealth and power.
Oh, for sure. He dives into the history of gold and how it became the dominant form of money for centuries. But he also discusses other metals that have played a role in monetary history, like silver and copper.
Interesting. I'm guessing the Spanish piece of 8 makes an appearance.
You know it. He devotes a whole section to the piece of 8, arguing that it was the world's first truly global currency.
That was back in the 16th century, right? When silver from the mines of Potosi in Bolivia was flooding into Spain and circulating throughout Europe and the Americas.
That's the one. The piece of 8 became the dominant currency for international trade, facilitating the exchange of goods and services across vast distances.
I bet that had a huge impact on the global economy.
It did. It fueled European expansion, trade networks flourished, and even early forms of capitalism emerged. But it wasn't all smooth sailing. Remember what we were talking about earlier with the cyclical nature of things?
Uh-oh, what happened? Did something go wrong?
Well, all that silver flowing into Europe eventually led to inflation. Prices started rising as more money chased the same amount of goods and services.
Classic case of too much of a good thing. It shows that even something as seemingly valuable as silver can lose its worth if there's too much of it in circulation.
A valuable lesson for any economy, really. It highlights the importance of managing the money supply and maintaining some semblance of price stability.
No doubt about it. So we've gone from cowrie shells to digital currencies, from the first global currency to the perils of inflation. What's next on our financial adventure? Where does Ferguson take us from here?
Well, next up is the world of credit and debt. And he starts off with a rather unexpected literary reference, Shakespeare's Shylock.
Shylock, the moneylender from the Merchant of Venice. That's an interesting connection.
Right. I never thought I'd see Shakespeare pop up in a book about finance. But Ferguson uses Shylock to illustrate the historical stigma associated with lending money and charging interest.
It's true. For centuries, lending money at interest was seen as immoral, even sinful.
Remember Dante's Inferno? Usurers get a special place in hell. But as Ferguson points out, without credit, economic growth would be incredibly limited.
It's a bit of a double-edged sword, isn't it? Credit can be a powerful tool for individuals and businesses to grow and prosper, but it can also lead to exploitation and financial ruin if it's not managed responsibly.
It's all about finding the right balance. And to illustrate the potential pitfalls of unregulated lending, Ferguson introduces us to a real-life loan shark named Gerard Law.
Okay, loan sharks. Now we're getting into the dark underbelly of finance.
Exactly. Gerard Law operated in Glasgow, and he wasn't afraid to use intimidation to collect his debts.
Sounds like a character straight out of a Dickens novel.
He was the real deal, charged exorbitant interest rates, and preyed on the most vulnerable members of society. His story serves as a reminder that financial systems don't exist in a vacuum. They're deeply intertwined with social structures and ethical considerations.
And speaking of ethical considerations, who does Ferguson bring up next?
The Medici family, a powerful banking dynasty that emerged in Renaissance Florence.
Oh, the Medici. Patrons of the arts, masters of finance, and, let's be honest, not always the most scrupulous folks.
It's true. They amassed immense wealth and influence through their banking activities. They were also accused of corruption and using their financial power to manipulate political outcomes.
A classic case of the complexities and contradictions that often surround wealth and power. So how does Ferguson tie the Medici into the bigger picture of financial history?
Well, their story serves as a bridge to the next major concept he introduces, fractional reserve banking. And that's where things get really interesting.
Fractional reserve banking. Okay, that's a concept I've always found a bit mind-boggling. It's basically how banks create money, right?
Not quite out of thin air, but they do have the ability to expand the money supply through a system where they only need to hold a fraction of their deposits in reserve.
So they lend out most of the money that people deposit.
Exactly, and that creates new money in the process. Ferguson uses the example of a game played by Harvard Business School students to illustrate how it all works.
Sounds intriguing. Tell me more about this game.
The students exchange promissory notes, which represent deposits and loans, and as those notes circulate, the total amount of money in the system expands, even though the initial amount of cash stays the same.
Okay, I'm starting to see how it works. It's like a chain reaction where money multiplies as it moves through the system.
Exactly. It's called the money multiplier effect, and it's a powerful tool for economic growth, but it also requires careful management.
What do you mean by careful management?
Well, if everyone suddenly decides to withdraw all their money from the banks at the same time, the system could collapse.
The dreaded bank run scenario.
That's where central banks and reserve ratios come in. They play a crucial role in regulating the money supply, ensuring the stability of the banking system, and managing inflation.
It's all about finding that sweet spot between encouraging economic growth and preventing the system from spiraling out of control.
Exactly. It's a delicate balancing act. And that brings us to the next stage in our journey through the ascent of money, the rise of bonds.
Bonds. Okay, now we're getting into the world of investment. I know bonds are a type of investment, but I've never fully grasped how they differ from stocks, for example.
Well, think of bonds as loans that investors make to governments or corporations. When you buy a bond, you're essentially lending money to the issuer for a fixed period of time at a predetermined interest rate.
So instead of owning a piece of the company like you do with stock, you're basically becoming a creditor.
You got it. And bonds have been around for centuries. Ferguson takes us back to their early forms, such as the Prestiti in Venice and the Monte in Florence, which were used to finance everything from wars to infrastructure projects.
So from those early examples, bond markets evolved over time to become the complex systems we have today.
Precisely. And they've played a crucial role in financing everything from empires to industrial revolutions.
I'm already sensing this is going to be a fascinating deep dive into the world of bonds.
You said it. We'll explore how they've shaped history, fueled both growth and crises, and continue to impact our world today.
Can't wait to get into it. I'm all ears.
All right, bonds. We left off with the idea that they're basically IOUs, but from governments and companies. But why are they such a big deal?
Honestly, I always get a little lost when it comes to bonds.
Well, imagine you're a government and you need money. Maybe for a big project like building roads or bridges.
Okay, I'm imagining.
Or maybe even to finance a war. These things take a lot of cash, often way more than you have readily available.
So what do? Raise taxes. That's one option. But it can be unpopular, especially if you need a lot of money quickly. That's where bonds come in.
Ah, so it's a way to raise funds without directly hitting taxpayers.
Exactly. By issuing bonds, the government is essentially borrowing money from investors, promising to repay the principal plus interest over a set period of time.
So it's like a loan, but on a much grander scale.
You got it. And it's not just governments that issue bonds. Companies can do it too, to raise capital for expansion or new projects.
Makes sense. Ferguson mentioned those early examples of bonds, the Prestiti in Venice and the Monte in Florence. It seems like borrowing money has always been a popular way to fund ambitious projects.
Oh, absolutely. Throughout history, governments and institutions have relied on bonds to finance all sorts of endeavors. And over time, those bond markets evolved, becoming more complex and sophisticated.
He talks about this relationship between bond prices and yields, and that's where I start to get a little fuzzy.
Yeah, it can seem counterintuitive at first, but it all boils down to investor confidence.
Okay, walk me through it. How does confidence affect bond prices and yields?
Imagine a government issues a bond with a certain interest rate, let's say 5%. That's the yield. Now, if investors are feeling confident about the economy and the government's ability to repay the debt, they're willing to pay more for that bond.
So the price of the bond goes up.
Right. But because the interest payment is fixed, when the price goes up, the effective yield goes down. It's an inverse relationship.
Okay, so if I'm understanding this correctly, a higher bond price means a lower yield and vice versa.
You're getting it. And the same principle applies to corporate bonds as well. The more confident investors are in a company's future prospects, the higher the price they're willing to pay for its bonds, and the lower the effective yield.
But why should the average person care about bond yields? It seems like something only Wall Street types would worry about.
Well, bond yields actually have a ripple effect throughout the economy. Think about interest rates on mortgages, car loans, even credit cards.
Oh, right. Those are all affected by bond yields.
Exactly. When bond yields go up, borrowing costs generally increase, which can slow down economic activity. On the other hand, when bond yields fall, borrowing becomes cheaper. which can stimulate the economy.
It's amazing how these seemingly abstract financial instruments can have such a real-world impact on our daily lives.
They're all interconnected. And to give you a real-world example of this, Ferguson discusses the situation in Japan.
Okay, what's happening in Japan?
Japan has a massive national debt, like really massive, and much of that debt is financed through government bonds.
So they've borrowed a lot of money from investors by issuing bonds.
Right. And if investors were to lose confidence in Japan's ability to repay that debt, things could get really messy.
How so? What would happen?
Well, if investors lose confidence, they'll start selling off those Japanese government bonds. And as we just discussed, when demand for a bond falls, the price goes down and the yield goes up.
So Japan would have to pay higher interest rates to attract new investors.
Exactly. And that can trigger a financial crisis. Higher interest rates would make it more expensive for Japan to borrow money, further increasing its debt burden. It could weaken the currency, lead to inflation, even push the country into recession.
It sounds like a worst-case scenario, a financial domino effect.
It's definitely something policymakers in Japan are trying very hard to avoid. It highlights just how crucial investor confidence is for the health of an economy, especially one with a lot of debt.
Debt seems to be a recurring theme throughout history, doesn't it? Nations, empires, even individuals struggling to manage their debts.
It's a constant balancing act. And speaking of managing debt, Ferguson introduces us to the Rothschild family, who became incredibly powerful players in the 19th century bond market.
The Rothschilds, weren't they like the ultimate banking dynasty?
They were. They built a vast international network connecting financial centers across Europe. They were masters of finance and diplomacy, bankrolling governments, financing wars, and basically shaping the global financial landscape.
Sounds like they were the original too-big-to-fail institution.
They definitely wielded enormous influence. And Ferguson uses their story to illustrate how bond markets can be used to finance both great endeavors and not so great ones.
Is he referring to the Confederacy's attempt to finance the Civil War by issuing cotton-backed bonds?
That's the one. It's a fascinating example of how even a seemingly valuable asset like cotton can lose its luster in the midst of political and economic turmoil.
So what happened? Why did the Confederacy's bond scheme fail?
Well, the Confederacy was counting on their cotton exports to back those bonds, but the Union blockade made it nearly impossible to get that cotton to market.
So the collateral was basically worthless.
Pretty much. Investor confidence plummeted, the bonds became almost worthless, and the Confederacy was left scrambling for funds.
It's a reminder that in the world of finance, perception is everything. If investors lose faith, even the most solid assets can crumble.
Absolutely. And from the perils of bond markets, Ferguson takes us on a detour into the nightmarish world of hyperinflation.
Hyperinflation. Now that's a scary word. Images of people pushing wheelbarrows full of cash to buy a loaf of bread come to mind.
Those images are sadly accurate. Weimar Germany is the classic example. After World War I, the German government, facing massive war debts and political instability, started printing money like crazy.
That seems like a recipe for disaster.
It was. All that extra money flooding the economy caused the value of the German mark to plummet. Prices skyrocketed, people's savings were wiped out, and the economy went into a tailspin.
Sounds chaotic. So it's like that Spanish silver situation we talked about earlier, but on a much larger and more destructive scale.
Exactly. It shows how crucial it is for governments to manage their currencies responsibly and maintain a stable monetary system.
So hyperinflation is a warning sign that something is seriously wrong with an economy.
Absolutely. And it's not just a historical phenomenon. We've seen it in more recent times in countries like Venezuela and Zimbabwe.
Right, places where economic mismanagement and political instability have led to runaway inflation.
It's a reminder that economic stability is a precious thing that can be easily shattered by bad policies.
Well said. But let's shift gears for a moment. Ferguson notes that in recent years, we've actually seen a bond market rally.
Yeah, that's right.
Yeah.
After years of low interest rates and fears of deflation, bonds have become increasingly attractive to investors seeking a safe haven.
So are bonds back in style?
They certainly seem to be. Central banks around the world have kept interest rates low, which has made bonds relatively more appealing compared to other investments.
And what about inflation? Hasn't that been ticking up lately?
It has. But many investors are betting that inflation will remain under control in the long run. And even with rising inflation, bond yields have remained relatively low, which has supported bond prices.
It sounds like the bond market is being driven by a complex mix of factors:
Hmm.
central bank policies, inflation expectations, investor sentiment, and who knows what else.
It's a dynamic system, that's for sure, and it's constantly evolving. But for now, at least, bonds seem to be enjoying a moment in the sun.
Well, that's good news for anyone who owns bonds. But let's move on to a topic that's even more exciting: stock markets.
Ah, the stock market, the ultimate symbol of capitalism, a place where fortunes are made and lost, dreams are realized and shattered.
It can feel like a giant casino sometimes, can't it?
It definitely has its ups and downs, but at its core, the stock market is a vital engine of economic growth. It allows companies to raise capital, investors to share in their success, and innovation to flourish.
Ferguson takes us back to the very beginning, to the origins of joint stock companies and the emergence of those first stock markets. It's fascinating to see how these innovations laid the foundation for modern capitalism.
Right. The idea of pooling resources, sharing risks, and allowing individuals to invest in businesses was revolutionary.
It's like crowdfunding, but centuries ahead of its time. Those early stock markets must have been pretty wild
Oh,
places.
I'm sure they were. Much less regulated than today's markets, and probably a lot more chaotic.
Imagine trying to track stock prices back then. No fancy computer screens or real-time updates.
It must have been quite the challenge. But even with those limitations, the basic principles of supply and demand were still at play.
Right. If people believed in a company's prospects, they'd buy up its stock, driving the price up. And if they lost faith, the price would plummet.
Just like today. The human element hasn't changed much, even if the technology has.
Speaking of human nature, Ferguson uses those two Business Week covers from 1979 and 1999 to illustrate how investor sentiment can swing from one extreme to the other.
Ah, yes. The Death of Equities cover from '79, reflecting the pessimism of the time, and then the booming tech-driven market of '99, where everyone thought the good times would never end.
Talk about a complete turnaround. It shows how quickly the market's mood can shift based on a whole range of factors, from economic data to geopolitical events to just plain old fear and greed.
It's a constant roller coaster. And Ferguson argues that understanding these swings in investor sentiment is crucial if you want to navigate the stock market successfully.
So, how do we make sense of these wild swings? Is there any rhyme or reason to them, or is it just all random noise?
That's the million-dollar question, isn't it? And Ferguson explores a range of theories and historical examples to shed some light on what drives stock market behavior.
Where does he start?
Well, he starts with the story of the Dutch East India Company, or VOC, as a case study of a successful early joint stock company.
The VOC, weren't they like the Amazon of their day, dominating trade in Asia and bringing back all sorts of exotic goods to Europe?
That's a great analogy. They were a true global powerhouse. And unlike many other companies that experienced boom and bust cycles, the VOC stock price remained relatively stable over time.
So they were a good example of a well-run company with solid fundamentals that could weather the storms of the market.
Precisely. But as we know, not all companies are created equal. And not all investors are as rational and level-headed as they should be.
Which brings us to John Law and the infamous Mississippi Bubble.
Ah, yes. A classic tale of speculation, mania, and ultimately disaster.
Tell us more about this Mississippi Bubble. It sounds like a cautionary tale for our times.
Well, John Law was a Scottish financier who came up with this grand scheme to exploit the perceived riches of the Louisiana Territory. He created a company, the Mississippi Company, and hyped up its prospects, promising investors untold wealth.
Sounds a bit like a modern-day pump-and-dump scheme.
There are definitely some parallels there, and people got caught up in the frenzy. They bought up shares in the Mississippi Company at inflated prices, driving the price up even further.
It's like that fear of missing out, that herd mentality that takes over when everyone else seems to be getting rich.
Exactly. But the problem was the company's actual operations couldn't match the hype. It was all smoke and mirrors. And eventually the bubble burst.
And what happened then?
Well, when people realized the company wasn't going to deliver on its promises, they started selling off their shares. The price plummeted, investors were ruined, and the French economy was thrown into chaos.
Sounds like a familiar story. We've seen this pattern repeat itself over and over again throughout history. From the South Sea bubble to the dot-com crash, people get swept up in speculative frenzy, only to be left holding the bag when the music stops.
It's a cycle that seems to be deeply ingrained in human nature.
So, are we doomed to repeat these cycles of boom and bust forever? Is there any way to break free from this pattern?
That's the question that has baffled economists and philosophers for centuries.
Yeah.
And Ferguson doesn't offer any easy answers. But he does provide some insights into the psychological factors that drive market behavior.
He brings up George Soros's theory of reflexivity again, right?
He does. And in the context of stock markets, reflexivity suggests that investor perceptions and biases can actually influence market outcomes, which then further reinforces those biases, creating a feedback loop that can lead to both bubbles and crashes.
So it's not just about cold, hard economic data. It's about the stories we tell ourselves, the hopes and fears that shape our investment decisions.
Exactly. And that's what makes markets so unpredictable. They're driven by both rational and irrational forces, by economic fundamentals, and by the collective psychology of the crowd.
It sounds like we need to be more aware of our own biases and how they might be influencing our investment decisions.
Self-awareness is crucial, and so is a healthy dose of skepticism.
Especially when everyone around you seems to be getting rich quick. It's important to remember that what goes up must come down. And when it comes to the stock market, the bigger the bubble, the harder the fall.
Well said. And from the world of stocks and bubbles, Ferguson shifts our attention to a different kind of risk management. Insurance.
Insurance. Okay, now that's a topic that everyone can relate to. We all have to deal with insurance at some point in our lives, whether it's for our homes, our cars, or our health.
It's something we often take for granted, but it plays a crucial role in protecting us from financial ruin. And Ferguson uses a very poignant example to highlight the importance of insurance. Hurricane Katrina.
Hurricane Katrina, a tragic event that exposed not only the physical vulnerabilities of New Orleans, but also the limitations of our insurance systems.
It was a wake-up call for many people. The sheer scale of the devastation and the economic hardship it caused highlighted just how vital insurance is for mitigating risks.
But insurance itself has a fascinating history, doesn't it? I mean, it wasn't always around. How did this whole concept of insurance even come about?
Ferguson takes us back to ancient societies that developed informal systems of risk-sharing to cope with unpredictable events like shipwrecks or crop failures.
It's amazing how those early societies figured out ways to pool their resources and share risks without the sophisticated actuarial models and financial institutions we have today.
It speaks to our innate human desire to protect ourselves from uncertainty and misfortune.
And from those early informal arrangements, insurance evolved over centuries into the complex industry we have today.
Ferguson traces that evolution, highlighting key milestones like the emergence of dedicated insurance markets, such as Lloyd's of London.
Lloyd's of London, the place where you can insure anything from a ship to a celebrity's body part.
It's become synonymous with the concept of insurance itself, and its history is intertwined with the rise of global trade, exploration, and risk-taking.
So from a coffee house in London to a global insurance powerhouse, Lloyd's has seen it all. But how did insurance go from those early informal arrangements to the data-driven industry it is today?
Well, a key development was the emergence of actuarial science, which uses probability and statistics to calculate risks and set premiums.
So it's not just about gut feeling anymore. It's about data, analysis, and sophisticated mathematical models.
Exactly. The rise of actuarial science transformed insurance from a speculative venture into a more predictable and data-driven business.
But even with all our sophisticated models and risk assessments, unexpected events like Hurricane Katrina can still expose the limits of traditional insurance mechanisms.
That's true. And this brings us to the concept of the welfare state, which acts as a kind of social insurance system, providing a safety net for those who fall through the cracks.
Ah, the welfare state. A topic that often sparks heated debates about the role of government, individual responsibility, and the balance between social safety nets and economic freedom.
It's a complex issue with no easy answers. And Ferguson provides a nuanced perspective on the historical evolution and the contemporary challenges facing welfare states around the world.
I'm curious to hear his take on this. Where does he start?
He contrasts the welfare state, which provides social insurance through government programs, with earlier forms of social assistance, like private charity and workhouses.
Workhouses. I remember reading about them in Dickens novels. Those grim institutions where the poor were often subjected to harsh conditions in exchange for meager assistance.
It's a stark reminder of how far we've come in terms of social progress. The welfare state, for all its flaws, represents a significant step forward in providing a safety net for those in need.
But as you mentioned, the welfare state is a complex issue. It's not without its critics. Some argue that it creates dependency, discourages work, and places an unsustainable burden on taxpayers.
Those are valid concerns. And Ferguson acknowledges the challenges facing welfare states around the world, particularly in the context of aging populations, rising healthcare costs, and changing social norms.
It's a balancing act, trying to provide adequate social support without creating perverse incentives or undermining economic growth.
Exactly. And Ferguson highlights how different countries have approached this challenge in different ways, with varying degrees of success.
What about the U.S. welfare system? How does it compare to other models, especially those in Europe?
Ferguson contrasts the U.S. system, which is relatively less comprehensive and more fragmented than European models, with the more extensive welfare systems found in many European countries. He acknowledges the strengths and weaknesses of each approach.
It's a reminder that there's no one-size-fits-all solution when it comes to social welfare. The best approach often depends on a country's specific circumstances, cultural values, and political realities.
Absolutely. And the debate over the role of the welfare state is likely to continue as societies grapple with the challenges of globalization, technological change, and demographic shifts.
It's a debate worth having. But for now, let's move on to the final destination on our financial journey, the world of hedge funds.
Hedge funds. The very name conjures up images of Wall Street titans, complex financial instruments, and high-stakes bets.
They're like the rock stars of the financial world, often shrouded in secrecy and controversy.
It's true. And Ferguson does a great job of demystifying hedge funds and explaining what they are, how they work, and the role they play in the global financial system.
So what exactly are hedge funds? What sets them apart from other types of investment funds?
Well, they're typically private investment funds that cater to wealthy individuals and institutions.
So not something the average person would invest in.
Not usually.
Uh,
Hedge funds are subject to less regulation than traditional mutual funds, which gives them more flexibility to pursue a wider range of investment strategies.
And those strategies often involve higher risk, right? That's how they aim to achieve those outsized returns.
Exactly. Hedge funds use a variety of techniques, including leverage, derivatives, and short selling, to try to outperform the market.
Okay, those are all terms I've heard before, but I'm not sure I fully understand them. Can you break them down for me?
Sure. Leverage is basically borrowing money to amplify your returns.
So it's like using a multiplier on your investment.
Exactly. If you're leveraged 10 to 1 and your investment goes up 10%, you make a 100% return. But if it goes down 10%, you lose everything.
Yikes. Sounds risky.
It is. And that's why leverage needs to be used carefully. Derivatives are another tool that hedge funds use. They're financial instruments whose value is derived from an underlying asset, like a stock or a bond.
So they're like bets on the future performance of an asset.
In a simplified sense, yes.
Yeah.
And they can be used for hedging or for speculation. For example, a farmer might use a derivative to lock in the price of his crops, protecting himself from a potential drop in prices.
That makes sense. But how would a hedge fund use derivatives?
Well, they might use them to bet on the direction of interest rates, currency exchange rates, or commodity prices. And they can get pretty complex. It's not for the faint of heart.
I'm starting to see why hedge funds have a reputation for being mysterious and even a bit shady.
They operate in a world of high finance that can seem opaque to outsiders. And they've certainly had their share of controversies.
What about short selling? That's another technique hedge funds are known for, right? Isn't that betting against the market?
It is. Essentially, you borrow a stock from someone, sell it at the current market price, and then hope to buy it back later at a lower price, pocketing the difference.
So you're profiting from a decline in the stock's value.
Precisely. It's a way to make money when the market is going down. But it's also a very risky strategy. If the stock price goes up instead of down, you could lose a lot of money.
It sounds like hedge funds are playing a very different game than traditional investors. They're using these complex instruments and strategies to try to outperform the market, often taking on significant risks in the process.
That's right. And their activities can have a significant impact on financial markets, both positive and negative. They can provide liquidity, facilitate price discovery, and even uncover market inefficiencies. But they can also amplify volatility, contribute to speculative bubbles, and even pose systemic risks to the financial system.
It's a lot to consider, and I'm sure there are strong opinions on both sides of the hedge fund debate. Some people see them as brilliant innovators, while others view them as reckless gamblers who threaten the stability of the financial system.
It's a complex issue, and there's no easy answer. Ferguson presents a balanced perspective, acknowledging both the potential benefits and risks of hedge fund activity.
He brings up George Soros's theory of reflexivity again in this context, right?
He does. He emphasizes the role of investor biases and feedback loops in creating market instability, which hedge funds try to exploit.
So they're looking for those moments when the market is behaving irrationally, driven by fear or greed?
Exactly. They're trying to outsmart the crowd and profit from the swings in sentiment. But as Ferguson points out, Even the most sophisticated hedge funds can get it wrong.
And when they do, the consequences can be severe.
He uses the collapse of long-term capital management, or LTCM, as a case study of how even brilliant minds can be brought down by unforeseen events and market irrationality.
LTCM was a hedge fund run by a team of Nobel Prize-winning economists, right?
They were the best and the brightest. They used sophisticated mathematical models and leveraged strategies to generate astronomical returns. But in 1998, a series of events, including the Russian debt crisis, triggered a cascade of losses that nearly brought down the entire global financial system.
It's a reminder that even the smartest people in the room can make mistakes, especially when they're operating in a complex and interconnected system like the global financial markets.
Exactly. And the LTCM debacle highlights a potential for systemic risk, where the failure of one institution can trigger a domino effect, leading to a widespread financial meltdown.
It's a sobering thought, and it makes you realize that risk management is not just about protecting individual investors. It's about safeguarding the stability of the entire system.
Well said. And from the world of hedge funds and systemic risk, Ferguson takes us to the final destination on our financial journey, the rise of China.
China, a country that has gone from being a relatively closed economy to a global economic powerhouse in a remarkably short period of time. It's an incredible story of transformation.
It is. And Ferguson argues that China's economic rise is perhaps the most significant financial event of the 21st century. He explores the historical, cultural, and political factors that have shaped China's approach to finance and its growing influence on the global financial system.
I'm eager to delve into this. China's economic transformation has been nothing short of remarkable. Where does Ferguson start his analysis of China's financial rise?
He starts by highlighting the long tradition of financial innovation in China, going all the way back to the invention of paper money and the development of sophisticated banking systems centuries ago.
That's fascinating. I didn't realize China had such a rich financial history. But he also explores the reasons for China's relative financial backwardness in the modern era, right?
He does. He points to a number of factors, including the political and economic isolation of China under Mao Zedong, the dominance of state-owned enterprises, and the lack of a well-developed legal and regulatory framework.
So those factors held China back for quite some time.
They did. But everything changed in recent decades when China embraced economic reforms and opened up to the world.
And that's when we saw that incredible surge in economic growth.
Exactly. Ferguson traces that remarkable transformation from a centrally planned system to a more market-oriented model that has unleashed unprecedented growth and lifted millions of people out of poverty.
It's a story of human ingenuity and ambition on a massive scale.
It certainly is. And Ferguson highlights how China's approach to attracting foreign capital has differed from that of other emerging markets.
How so? What did they do differently?
Well, unlike many other developing countries that relied heavily on foreign borrowing, China focused on attracting direct investment.
So they encouraged companies to build factories and invest in infrastructure within China, rather than just lending them money.
Exactly. It was a more strategic and cautious approach, and it paid off. China was able to build up its industrial base and accumulate vast foreign currency reserves.
And that has allowed them to become a major lender to the U.S., right? Talk about a role reversal. China, once a recipient of foreign aid, is now a creditor to the world's largest economy.
It's a remarkable shift in the global balance of financial power, and it has profound implications for the future of the global economy.
Implications that we'll explore further in the final part of our deep dive into the ascent of money. Last time, we were talking about China's incredible economic rise and what it means for the global financial system. It's kind of like the world's financial power is shifting, isn't it?
Yeah, it's a pretty big deal. And Ferguson really dives into the implications of China's rise, especially for the existing global financial order.
Which has been dominated by Western institutions and, of course, the U.S. dollar for so long.
Right. The dollar has been the world's reserve currency for decades. But now you've got China's economy growing, their financial influence expanding.
It makes you wonder, is the dollar's dominance actually in jeopardy?
It's a question a lot of people are asking. Some analysts think the dollar's days are numbered, that as China's power grows, the dollar's going to decline.
They point to China trying to make their currency, the yuan, more international.
Yeah, they want the yuan to be used more in global trade and investment, and they've been pushing for it to be included in the IMF's basket of reserve currencies.
That's a pretty big deal, right?
Yeah.
Being part of that IMF basket.
It is. It's a sign that China is serious about challenging the dollar's dominance. But, there are other analysts who think the dollar's not going anywhere anytime soon.
What's their argument?
They say the U.S. financial markets are still the deepest and most liquid in the world, that U.S. institutions are strong. Plus, there's not really a clear alternative to the dollar as a global reserve currency.
So it's like a financial tug of war between the old guard and the rising power.
Yeah, that's a good way to put it. It's this tension playing out on the world stage. As China's influence grows, the old financial order is having to adapt.
It's not just about currencies and global power, though. China's rise is affecting its own people, too.
Right, and Ferguson talks about the progress China's made in lifting millions of people out of poverty. Their standard of living has improved dramatically.
But they still have challenges.
Well, for sure. Ferguson mentions income inequality, the environment.
Right.
Plus, there's still a need for more economic and political reforms.
It's a journey and not a destination, right? They've come a long way, but there's still a long way to go.
Absolutely. And Ferguson doesn't pretend to have all the answers about what the future holds for China.
Yeah.
He just lays out the facts and encourages us to think critically about it all.
So we've covered a lot of ground here. We've talked about everything from cowrie shells to digital currencies, from the Medici to the Rothschilds, from bubbles to crashes. What are the big takeaways here, would you say?
Well, I think the overarching theme is that the ascent of money is really a story about us, about human beings.
It's about our ingenuity, our creativity, our ambition.
And our greed, let's not forget about that. Our capacity for making both brilliant and terrible decisions.
It's like finance is this mirror reflecting all of humanity's strengths and weaknesses, all our triumphs and failures.
I like that. And that's what makes financial history so fascinating. It's not just about numbers and charts. It's about the drama that unfolds when money, power, and ambition collide.
So what about the future? Where do we go from here?
Ferguson doesn't have a crystal ball, of course, but he does talk about some of the trends that are shaping the financial world right now.
Like what?
Well, globalization is a big one. And we've already talked about the rise of China, but there's also technological innovation.
Fintech, crypto, all that stuff.
Yeah, technology is changing everything about how we interact with money. It's blurring the lines between traditional finance and the tech world.
I mean, think about how we pay for things now. Mobile payments, contactless cards. It's all so different from even a decade ago.
And it's just the beginning. We're on the cusp of even bigger changes.
It's exciting, but also kind of scary. I mean, what are the implications for privacy, security, regulation? It's a lot to wrap your head around.
It is, and it's going to be interesting to see how it all plays out.
What about demographics? That's another big factor shaping the future, right?
Absolutely. We've already talked about aging populations in developed countries, but there are also the rising middle classes in emerging markets. All these demographic shifts are going to have a huge impact on how we save, invest, and consume.
It sounds like the future of finance is this complex mix of globalization, technology, and demographics, all interacting in unpredictable ways.
It's a future full of both promise and uncertainty. But as Ferguson reminds us, history can be a valuable guide.
Right. By understanding the past, we can better prepare for the future. And he also leaves us with a warning, doesn't he? About how our brains are wired to be fooled by randomness.
Yeah. We see patterns where there are none. We make bad decisions based on flawed assumptions.
We're all susceptible to it, even the experts. And Ferguson reminds us that when it comes to finance, it's crucial to be aware of our own biases and to think critically.
He stresses the importance of financial literacy, not just in terms of understanding the mechanics of money, but also in terms of developing the critical thinking skills we need to make sound decisions.
So it's about more than just knowing how to balance a checkbook or invest in the stock market. It's about understanding how the financial system works, how our decisions impact the economy, and how we can use our financial power responsibly.
Exactly. It's about being informed, empowered citizens, not just passive consumers.
Well said. I think that's a great note to end on. We've covered so much ground in this deep dive into the ascent of money. We've explored the history, the complexities, the triumphs, and the failures of the financial world.
It's been a fascinating journey for sure, and I hope our listeners have enjoyed it as much as I have.
Thanks for joining us on this exploration of the ascent of money. And remember, the journey continues. We all have a role to play in shaping the future of finance, so stay informed, stay engaged, and keep those thinking caps on.
See you next time.